And welcome into the program. This is your game plan for retirement with Northwestern Ohio's resource for a common sense approach to planning for your financial, investment, and retirement future. He is president and founder of McIntire Retirement Services. Chris McIntire here with us, the head coach, the coordinator, if you will, for your game plan for retirement. We always appreciate the time, the perspective, the insight, guidance, information, Chris, and you try to help people get on track with their money or stay on track with their money or find a better path with their money so that they can live life with confidence. And one of the things that we're going to be talking about today is a mental transition from the way that we're sort of trained to think about our money to maybe kind of what really matters. And so we'll talk about the lump sum psychology on today's show, and then how to create true financial confidence. And Chris, again, always appreciate your time, but as you normally do, kicking us off with a tip of the week.
Sure. Yep. Tip of the week is, that retirement planning is not just, a one and done. It is a process. So, you're going to go through different phases of your retirement. You initially retire, you're worried about yourself and your income and your spending habits. As you get older, then you start worrying more about health issues, the estate planning side. And then, my parents are still alive, one in a nursing home and a 92-and-a-half-year-old father. And, it's the legacy and the long-term care planning and things like that. So, yep, it is a process that we go through where I'm focused on me. And then later on in life, a lot of times you're focusing on your family and how do you give money to them and so on and so forth.
But Chris, the thought of how much do I have? What is my net worth is kind of the dominant thought that we've been trained to focus on. I mean, you just mentioned a number of different elements and phases and concerns in planning, and none of them had to do with a net worth or a lump sum number. Why is that such the focus while we are looking at how we are doing financially and how confident we feel about our finances?
Sure. I mean, I run a net worth statement every month for Robin and I. I'm sure you do as well. But when I bring up my investments on the computer and I'm looking at them, right, I'm looking at what was the dividends and interest that paid out this month, and I don't need it for income. I just love dividends. I'm getting work for my money. And, regardless of the price of the stock, I'm reinvesting that. So I'm set up to get, $50,000 in dividends this year. I'm reinvesting that. That's like making a contribution to my, to my 401k, So, that's the focus, especially for the retirees today. Might not be on this, this grand scheme of thing. They want to narrow down here and, how do I develop income out of this lump sum of dollars, I think is where we're going to transition.
Yeah. And the question, again, that we've been trained to focus on, how big is my portfolio? But a big number does not guarantee financial confidence. And two people with the same number might have very different financial situation. So income is what drives lifestyle and the ratio of spending and the income plan, not the number on the balance. But I think, Chris, that number is an easy benchmark to reference, is an easy measuring stick. And so that's sort of how and why we've been trained that way. Is it higher or lower than the year before? Is it higher or lower than my neighbor or my brother or my cousin? And maybe that is a frame of reference that through today's program, we can get people to reconsider, because there are other benchmarks, there are other measuring sticks, and there are ways to establish financial confidence or increase that financial confidence regardless of that lump sum number. And so that's what we'll be talking about on today's program. But again, ladies and gentlemen, that is what we continually emphasize here on the program, is that the plan is what bridges the gap between the lump sum number and the feeling of true lasting financial confidence, and why Chris McIntire and the team from McIntire Retirement Services offer to put together that game plan for retirement for you, your game plan for retirement, personalized, customized, long-term vision, reflecting your goals, diversified strategies on how to achieve them. And if you would like to take Chris and the team up on the offer to get your game plan for retirement put together or review your current plan, just give them a call. Start the conversation, 419-332-0532, 419-332-0532. 0532 419 332 0532 or online McIntyre Retirement Services.com. McIntyre Retirement Services.com. So, Chris, is it a mirage or something that we've been trained by Wall Street that this should be the focus when we're thinking about lump sum, or does this matter and play into our sense of true financial confidence?
And it's an irony here is that, back in the day, Peter, as we didn't see many people that were millionaires. If you did, that person was genuinely wealthy. Okay.
Yep.
Today, a lot of people have $1 million in a 401k or an IRA or a total package, total investment portfolio, and they don't feel nearly as rich as what the predecessors did 10, 15 years ago. Inflation and all that. So can erode. But my people that have these wonderful structured incomes, they feel very comfortable, even though their nest egg might not be $1 gazillion, because they have structured income, pensions, Social Security, annuity payments. That's what they live off. The rest of it's fluff, and things maybe that they're going to pass on to their family. So, we deal with a lot of folks that have that ability in their retirement to say, look, they're offering me a lump sum, or should I take the pension payment? Okay. And, we work that math out. And, just to make it simple for the folks listening to the show or watching the podcast is, if you had a $200,000 lump sum buyout that you could move into an IRA, so that's not a taxable event. When we're talking lump sum, we're not talking about paying taxes on a big fat 401k or a pension plan. Transition that into an IRA. Okay, so 200,000 there, or take $1,000 a month for a pension. Okay, which of those is the best? Okay, well, I wouldn't say it's not a which one's the best. It's what's appropriate for the particular situation we're dealing with. So 200,000 would have to generate 6% in dividends and interest to equal $12,000 a year. So, we kind of, work that math. All right, what's the likelihood that we can make that happen? Or can we find another annuity that will match what your pension does? But if you pass away, your beneficiaries gets what's left. And a lot of times pensions are, a husband gets it. If he passes away, the wife might get some, but if they get killed in the same car wreck, for example, it's done. So, we help people steer into what are those best options that they have. And I think, we obviously, do this all day, every day. And, sometimes we trivialize it because you do it all day, every day. You have to realize you're dealing with someone's life savings. It has taken them 30, 40 years of hard work to get to where they're at. And, we want to help steer clear of the emotion and deal with the logic.
I'm going to trivialize it as well. Nuances. There's a lot of nuances there that you just described, Chris, but those nuances and the decisions that we make about them have huge impact and consequence on the feeling that we have of lasting financial security and confidence. And I'm going to restate another thing that you said here. This generation, Chris, has far more wealth. Their lump sum, their numbers are way bigger than previous generations. We have saved and accumulated more money, but for some reason, this focus on the lump sum number, there's more doubt and worry and uncertainty with this generation, even though they are wealthier. So the benchmark of how much you have in your 401k or IRA, it does not tell the whole picture. The number doesn't tell the confidence that we have, because a lump sum represents potential, not certainty. And accumulation is only one phase of building that certainty. And you help people understand those phases and making the transition from the lump sum to the confidence.
Yeah, absolutely. Cash flow increases your confidence. It lets you go to sleep at night. You know that you got money coming in, and then that should help you, deal with the times of volatility. And, look, we're talking about investments in the stock market. So volatility, it's just there inherently. And, I think, we get that across, the political landscape, no matter who's in charge, whether it starts with an R or a D, good things happen, bad things happen anytime in the world. So as we look at like, especially, we're talking about income on today's show, we certainly help people with the growth side of their portfolio as well, but take gold, for example. Gold is a commodity. It doesn't pay a dividend. So, it's hard to generate income off of gold if the price of it's going down.
You got to spend some money selling gold, buying gold at one price below spot price, selling gold at another price. Yeah, you don't get what it's actually quoted at that time, and there's a process for doing it. And Chris, I know we could go on a whole show on a tangent on just gold, but there are multiple different ways to buy gold inside of the investment portfolio versus the physical asset. But again, neither one of those going to create financial security and confidence. What are some of the tools that create that confidence? Social security, maybe an emergency account, some lump sum of money that isn't invested in the market to cover periods of time that markets would have volatility. Pensions, annuities, rental income, all things that I've heard you mentioning, dividends in stocks, but the income that the portfolio can generate. That's the paycheck, right?
Yeah, absolutely. And after you've done this for a few decades, you can read the client. So when we've got somebody that's just retired and they're said, hey, we'll just use $1 million because it's easy math here. I got $1 million in my 401k or half a million, and I need to generate, $25,000 a year off of that. Okay. Well, on $1 million, that's 2.5%. On $500,000, that's 5%. So, you can kind of see the challenge there. So, most people are familiar with that 4% rule. That's kind of a rule of thumb, if you will. I think a nuance or a cliche. So if I got $1 million, I can create $40,000 of income. Okay. Well, what if we can create $40,000 of income out of $600,000 instead of a million? Now you got $400,000 to maybe invest it a little more aggressively or do some more vacations or things like that. So when you present those solutions to clients and you're like, oh my God, I didn't know that I could do these kind of things. So, that's a very rewarding in our world to, kind of turn the lights on and, and see how they become more confident. They're like, are you kidding me? I'm going to have this much income in and, heck, I didn't make that much when I was working. There are people that actually make more money in retirement because they got a pension and Social Security and, some nice savings. And, that's what the American dream is all about, man.
So, Chris, do you see that there is a distinction then between wealthy and financially secure?
Oh yeah, man. Yeah, without a doubt, because and I'm not boasting on myself or anything, but it's like some people would say, "Oh man, you're very wealthy," It's like, but I still don't feel all that financially secure, we have a nice lifestyle and whatnot, but we're still working, and as you get a little bit older, I'm telling you, you start to see, you really appreciate the concerns of the other people sitting on the other side of the table from you. Whereas if if your financial advisor is 35 years old, he might know all the tech stuff, but they haven't been through many of the storms there. And I'm looking at Peter. Peter's not 35. He might look at folks,
Yeah,
but
46,
yeah,
46. I've seen a couple of them.
yeah, we've been through a couple of them together, my friend, haven't we?
Yeah, indeed. But wealthy is a number. Security is a system. Income planning is really, Chris, what bridges the gap between the two. And I know that we talk about income planning, but the reality is that retirement is a paycheck problem, not a lump sum problem.
Yeah, yeah, it sure is. And as we walk through all of these processes that we have in place to introduce these concepts to clients, are we talking about structured products? Are we talking about annuities? Are we talking about CDs or bond interest or dividend paying stocks? And if you think of, companies like utility companies, they're famous for paying dividends and typically hold up fairly well in times of trouble as well. So, as we deal in this retiree market, most of them are like, look, I think I've got enough to get me through the end of it. I don't want to take any chances I don't need to be taking now. So a lot of people want to de-risk a portfolio. And if you think about it, the riskier you are, the higher the reward potential could be. Okay. However, as Peter and I have talked about many times here, is that offense wins games and defense wins championships. And we say that as Peter's Carolina Hurricanes are, taking it to the Ottawa Senators in the NHL playoffs, and we're happy for that too. Even
Yeah,
as
well,
even being a Red Wings fan.
maybe the eighth time is the charm for us, Chris. We're a perennial playoff, never the cup. So we'll see if the eighth time will do it for us.
It's a hard one to win, that's for sure.
Indeed, indeed. Chris, I want to actually go into the psychology of this, though, the mindset of I'll generically say the middle class, but of investors that wouldn't consider themselves ultra wealthy, that are of this category here that we're talking about today, where we've been taught to focus on the number that we've built up, stored and hoarded in an account. And compare that to the mindset of those who truly are wealthy, who have that financial confidence. I don't think that it is the mindset of those individuals to build up the highest value that's sitting there looking at me when I look at my balance sheet. They try to deploy money as quick as possible to go out and create more income. They know that if they invest money places that's creating income, ultimately that is building their net worth and their financial situation, not a balance sheet on a statement.
Yes, yeah, I couldn't agree more with that. And, and some of the mistakes people make in doing some things along these lines is, getting nervous because of the stock market, for example, and pulling out and going into cash, or, being way too conservative, when times are good. And, as we're looking at things right now, right, we got the Strait of Hormuz. One day it's open, one day it's closed. That certainly has spiked oil, spiked volatility, inflation threat, but yet the market has continued to set new records. Companies are beating their earnings. Now, we don't know what the future is going to hold, a year from now, 6 months from now with this obviously situation in the Middle East. I think most of us would agree that's a hot spot on a good day.
Mm-hmm.
And what we're looking at now.
Hey, Chris, we talked on a very recent show, and you made a statement that has stuck with me: is that short-term volatility is not the same as long-term declines, as we were discussing the resiliency of the stock market.
Yeah, absolutely. Companies still reporting good earnings records. We don't know if that's going to hold for 6 months, 12 months down the road. We have the uncertainty of the upcoming midterm elections and, political parties gerrymandering here and there. It's just, it feeds the volatility, and, but the market gets used to that, and investors, and, we're talking pension funds and corporations, and not just individuals, huge investors that make moves when they're ready to, they just don't pull into cash on one day and then reinvest the next day, because all of a sudden what they heard Jim Cramer say today and then what he says tomorrow are two completely different things.
But Chris, if we do have this hardwired into us, this psychology of focus on the lump sum, build it bigger, never let it go down, and that's the most important thing. If that is how we have been trained and wired, then I think that we are, as investors, more emotionally reactive to the headlines that drive short-term volatility rather than the focus on the tool and the power that the market provides us when we have the confidence of an income plan that lets us survive volatility.
Yeah, yeah, without question. And, I mean, just a recent example, that market, was pretty volatile there earlier in the spring. And, so I took some money we had sitting in a savings account and bought stocks with it, because the market was down. I took advantage of an opportunity, and, and you do that, we obviously do that on a monthly basis, but when we see another opportunity, we take advantage of that. For the retirees, and the money's going the other direction, is they might not be invested in the same things that got them to the point to have that big lump sum of number. They may be in more conservative items like dividend paying stocks versus, growth stocks and, artificial intelligence. That's obviously been very good, but not all those companies are income producers.
But we're not saying, Chris, that suddenly at retirement you shift everything from lump sum accumulation, swing all the way to the other end of the spectrum here and go to safety and withdrawals as being the only focus. It's just that we have provided the income to support the growth in the market during our working career. After retirement, we don't have that paycheck. And so we have to start balancing with growth and income rather than having our investments only be about that growth, right?
Yes, yeah, and I think a good example here is to say, hey, Mr. and Mrs. Prospect or Mr. and Mrs. Client, this is what we can do for you. This is the income we can get for you. If we can do this, you have this much money left over. How much risk tolerance do you have on the money that you don't need to meet your income?
And you mentioned earlier, Chris, like the example of the $1 million. Following the 4% rule, Wall Street's model, that's $40,000 of income. Well, what if we could do that with less? This actually creates more opportunity for growth with having discretionary money, not less. So actually, income planning creates the opportunity for more growth, not less.
Yeah, absolutely. Because if you said, all right, I'm going to park $1 million in a CD paying 4% or a government bond paying 4%, okay, you can't use that $1 million for anything else. But like Peter says, if we can take, 600, $700,000, get a little higher yield on it, now you've got extra money. Now you've actually freed money up, to help, with that long-term growth, because at some point down the road, inflation and whatnot, you may need to shift some of those other dollars. And, what would obviously be ideal just to take the gains and shift them over.
Yeah. So the bottom line, income creates stability and confidence. Confidence in your income, stability, predictability, freedom financially, that we can live life, we can do those things. Confidence is coming from that cash flow. And income planning is what turns wealth into usability. And the structure creates the peace of mind. So, Chris, again, with the focus on income and investments and rate of return and lump sum, we have never really been trained to map out income. And that's, I think, the biggest takeaway from this program is the mapping out of the income generation is one of the biggest services that you offer there at McIntire Retirement Services. Now, of course, tax efficiency goes into that as well, maximizing benefits and Social Security and minimizing cost of Medicare. But all of that is the income plan that creates our lasting sense of confidence after we leave the paycheck.
Yep, absolutely. And, it's something that we, kind of geek ourselves out on, between income plans and helping people pay less in taxes or do the Roth conversions, and maybe not less in taxes all the time, but we want to make them be efficient in paying their taxes, right? If we're dealing with clients that, say, look, I want to, I don't care about Roth conversions. I'm going to leave my kids whatever's left in my IRA account and they can worry about the taxes. That's one thing. Other people might be more proactive and say, look, can I pull out another $15,000, $20,000 and move it into my Roth and convert it? Because remember, not everybody can contribute to a Roth IRA, but anybody can convert an IRA to a Roth, regardless of income, regardless of age.
I've heard that comment as well, Chris. Well, I'm leaving money behind. They can deal with the taxes. Fair enough. I get that. I understand that. But if you leave it behind, they might be paying more. And I don't think anybody wants the IRS to be their largest beneficiary, right? That's not the blood relative that we want to leave things to.
Yeah, and we've been talking about lump sum. So, you pulled $100,000 out of your IRA account, typically you're going to be giving a pretty good chunk of that to the Internal Revenue Service or the state of Ohio in our example here. And that's why some people who achieve a fair amount of financial success, they might move down to Tennessee or Florida because they don't have any state income taxes. And, that's pretty rare. Not everybody wants to do that, but we have several clients that are now residents of different states, and they have to spend 6 months in a day, but it saves them state income tax.
Yeah, but they got to sweat a lot more too.
Yeah, and they don't have to shovel snow. So
well, okay, there's that. Benefits and disadvantages on all sides, right, Chris?
You got it.
Financial success, not just about building wealth. It's about building a system to use it effectively. And Chris, that I think is the biggest takeaway and the biggest service that you offer there at McIntire Retirement Services. Access to the market these days is kind of commoditized. We can do that in any number of places. But if you call up that brokerage house and say, well, how do I utilize it? Well, they don't know you. They don't know your situation. They don't know your name. They know you as an account number. Whereas you help somebody map out how to take the access to the market that we've had and what we've built and turn it into a plan reflective of their goals, their timelines, their hopes, dreams, and expectations.
Yeah, in our firm, we get support from Brookstone Capital Management, obviously, and we can use CPAs to help with the tax planning side, because if you call up the brokerage firm on the 800 number, and you say, hey, I want to convert some money to a Roth, what would my tax be? They're going to tell you, well, we don't give tax advice. We just want you to park your money here. We get paid on where it's parked.
Yep. Again, the lump sum, that equals potential, but the planning equals the execution. The plan turns one into the other. And that's why Chris McIntire always makes the offer to help you put that plan together, your game plan for retirement. If you'd like to get that for you or double check your current plan or accounts and make sure that you've got that lasting confidence, that you have not overlooked any important aspects, pick up the phone, give McIntire Retirement Services a call, 419-332-0532, 419-332-0532, 419-332-0532, and online at McIntireRetirementServices.com. Lots of great resources. You can start your journey there, but the best, start with a conversation. Get to know Chris, Ross, Heidi, the team there at McIntire Retirement Services. They're a family and would love you to be a part of that as well. So give them a call, 419-332-0532 for your game plan for retirement. Chris, always a pleasure having you on the program.
Hey, my pleasure. Good to be with everybody. May God bless America and keep us safe.
Tune into Chris McIntire's full radio program and visit McIntireRetirementServices.com for many additional valuable resources, including other great episodes of Game Plan for Retirement with Chris McIntire. Be sure to subscribe.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookstone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.